Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello, welcome to the COB this Tuesday afternoon. I'm Juliette Sarli. Great to have your company on a day which started out so positively but has ended with a bit of a whimper, although importantly still in positive territory. Let's have a look at where the CBO 200 is finishing the day's trade, only firmer by 1/3% despite a very solid start to the day's trade. The ASX 200 a little bit firmer, 0.4%, just holding on to that 8,400 point level as we head into match-off. But of course it was all the reaction to the so-called taco trade, if you will, that happened on Wall Street overnight, and this amid Trump's turnaround, really indicating that he'd ordered the military to postpone strikes against Iranian power plants following what he called productive conversations with Tehran. But then Iran turned around and said, hey, that's fake news. Nevertheless, we did see oil prices, of course, fall by around 11% on Wall Street. But as I mentioned, the relief rally that we started with ended on a bit of a receding note towards the end of the day's trade. We'll get into that with Martin Crabb from Shaw & Partners in a moment. But of course, we're also watching inflation very closely ahead of the CPI print tomorrow, that inflation anticipation in play. We've got to remember this is backward looking. I had a great chat to Sian Fenner from Westpac earlier today saying that they have done a little bit of modelling into terms of how long this escalation continues, what sort of impact it's going to have on inflation. It's already getting towards their base case scenario of 1 month. We're almost pretty much at that level, and the escalation in the Middle East coupled with last week's rate hike means that consumer sentiment is at the lowest level since 1973 when the ANZ Roy Morgan data goes back. Let's have a look in terms of what we're seeing with sectoral moves today, kicking it off with the materials stocks, which were a bright spot. Mineral resources up 5.4%, BHP and Rio looking good. Iron ore futures higher on these elevated freight rates. Energy stocks today are taking a bit of a breather, particularly Santos there, down 2.2%, with crude oil falling below $100, but it has climbed back above that in Asian trade. And having a look at IT stocks as well, they were a little weaker. WiseTech off by 4%. Meanwhile, down at EDI, secured a $500 million contract with Stockland, shares up by more than 2%. Myer also in focus. It had a good Black Friday, which helped out sales in the first half, and it says sales in the first 7 weeks of the second half are up 1.7%, but it has warned of volatility. No surprise given that consumer sentiment is in the doldrums. KMD brand says it rejected an approach from US surfwear group Stokehouse. Shares were higher today. Echo IQ gained the most in over 2 months on a deal with the US hospital firm Mayo Clinic, and Orica a little weaker. It's managing potential supply disruptions following an outage at a supplier's ammonia plant in WA. Let's get into the details now with Martin Crabb from Shaw & Partners, who joins me on the desk. Good to see you, Martin.
Good to see you too, Juliet.
As you said, not quite the positive day we were expecting when we woke up.
No, we were looking at, 150, 160 point move higher in the futures, and the taco trade, Taco Tuesday, we were calling it in our morning meeting. But yeah, as you mentioned, the fake news coming out on what talks actually took place. You kind of need two parties to have talks, right? You can't just have talks with yourself.
Yeah.
So yeah, the oil market's all over the place. The gold market was down, really heavily during the session last night, and then it bounced on the comments. So we had a bit of a bounce this morning. The material sector was all sharply higher, but as the day went on, people just sold into it. So I still think people are not sure what to do with this market. No one's really committing to either sides of the tail. When I say that, it's like, is it going to go on a lot longer and get really bad? What stocks do you own in that scenario? Or is it going to, is it going to be a taco? Are we going to see Trump just pull out of the whole thing and we're back to normal in a couple of weeks? And there's a bunch of stocks that are going to do really well if that happens. People don't seem to want to play that trade. They're sort of going somewhere in the middle and either sitting out of the market altogether or just sticking with the same old boring stocks they've always had.
So do you therefore hold off because markets could slump further, or do you look for some pockets of value here?
Yeah, look, it's a good question. It's one that everyone's struggling with, right? When you have high levels of uncertainty, and we can measure that in a number of ways. One is the TSR of the market, which I'll talk about a little bit in a minute, but also the volatility index. So if you look at the VIX index, which is just basically a measure of fear, when that spikes, the markets tend to sell off because people are very uncertain about what to do. They are, generally speaking, opportunities to buy. When you see a spike in the volatility index, it's generally a good buying opportunity. Not always, because sometimes things can get a lot worse. COVID's a really good example of this. But 9 times out of 10, when there is a spike of volatility, just a whole bunch of uncertainty. I can think about, Liberation Day. I can think about when Credit Suisse went broke, and so you have these moments where the market gets really uncertain about something. It sells off. There's a spike in the VIX. When you buy that, you generally do pretty well.
So you touched there on that TSR index. Let's bring it up, where you can potentially see some value. What are we looking at?
So this is a measure we like to use just as more of a common sense. Where's the market trading? The black line is the consensus target prices for all the stocks in the index. And you can see it's going up, Juliet, which means analysts are generally speaking revising target prices and earnings estimates higher. Maybe there's a lag there. If there's higher fuel prices, maybe that starts to cut into valuations, but we're not really seeing that at the moment. The analysts are upgrading stocks, target prices and earnings. The red line's the market. Obviously, it's deviated quite dramatically. The grey line is a 15% total shareholder return. So if the market hits that level and it goes to the black line over the next 12 months plus dividends, you're getting 15%. So it's only really 6 times in the last decade that we've seen that breach. So in a couple of material ways, obviously COVID was a material breach of that. The big bond market sell-off in 2022 when all the central banks were dramatically hiking rates and that black line was heading down, like people were downgrading earnings. And then we've had the 3 sort of events. We've had the Credit Suisse, banking crisis. We've had the Liberation Day reciprocal tariffs, and now we've got the Iran war, and they've all resulted in this sharp sell-off in the market. The last couple of times it's bounced pretty hard. They've been like one-off because of Tarko. Maybe we're going to see that again. But it's just like if you're sitting on a pile of cash and you've been waiting for a sell-off, here's the sell-off. And they don't come very often. 6 times in a decade is not a lot. So you want to take advantage of them, I think.
And if there is a rapid resolution and things move quickly, you're looking in the naughty corner. What's in the naughty corner?
Yeah, so what is the naughty corner? So we all probably know that from our school days, depending on our age, where the naughty kid gets stuck in the corner and you've got to face the wall because you've done something bad. So the share market version of the naughty corner is stocks trading at a significant discount to their long-term valuation. So let's look at a really basic measure like price to book. So the book value of the assets of the company, right? So looking at a company that's trading at a big discount to its average over the last 10 years, that's one metric. And the other thing is how far is its share price from its 52-week low? Is it at its 52-week low or is it trading up towards the top? So here we've got just stocks in the ASX 100 and we've said, right, if you're trading at less than 50% of your average price to book valuation, so you're trading at the bottom end of your range, and then you're also trading towards the bottom of your share price move for the year. And there's 10 odd stocks on there. We're just looking at some themes. You've got 3 big healthcare stocks in there, or relatively big healthcare stocks. We've got Cochlear, CSL and Telix Pharmaceuticals, which is a relatively smaller company. Then we've got the software stocks, particularly the software as a service stocks. So Xero, Pro Medicus, WiseTech. You could argue car sales and Seeker a little bit in that camp as well. And then you've got a gold miner and a couple of companies that are in, I suppose, the wrong side of the fuel cycle. So we've got, I think is Amcor on there because they obviously are a big buyer of petrochemical products, and then Qantas with airline fuel. So there's a couple of themes in there that have been really knocked around. So if you're looking for a recovery, like we don't know what tomorrow's going to bring, right? Particularly with Donald Trump. But if there is a quick resolution, you can expect those stocks are going to bounce really, really hard. They're very oversold. They're trading at big valuation discounts. So with the exception of healthcare, which is probably not related to Iran, most of the other stocks are down there because of the geopolitical issues. And if they're resolved, they'll bounce pretty hard. So that's one way of playing the market at the moment.
And it was interesting on Wall Street. I mean, American Airlines, United Airlines, Carnival Corp, Norwegian Cruise Lines, they all gained like 5 to 6%.
Yeah.
You're also looking at fuel refiner and distributors.
Yeah.
So we know that the ACCC is looking at this too. Where do you see upside in the likes of Viva, Ampol, if the disruption continues?
Yeah, well, there's only really 2 refining businesses left in Australia. Most of them are closed down. You've got the Lytton refinery up in Queensland, which is owned by Ampol, and then you've got the Geelong refinery, which is owned by Viva Energy. And so these are the only ways we can produce end products. 90% of our automotive fuel, our airline fuel, jet fuel, diesel, most of that's imported. And if those supply lines start to dry up, then the extra margin that a refiner can charge to produce product goes up quite materially. And so these companies are very, very leveraged to that. So yes, you can buy Santos and Woodside because they're just leveraged to the underlying prices, but the derivatives of those, things like jet fuel and diesel and so forth, you can charge a lot more. So Viva and Ampol are probably even more leveraged to this thing dragging on. So if this thing does drag on, it's going to have a lot of really negative impacts for companies that rely on fuel. So that might be retailers, that might be food companies, it might be building companies, it might be some of the miners. Like what if BHP and Rio run out of diesel, for example, or gold miners run out of diesel? That can shut their entire business down. So the flip side is these refiners will do very, very well. So I've seen some scenarios with, if Straits of Hormuz stay closed for another month, we could see like 100% upside to earnings of some of these companies because they're very leveraged. Does it last forever? Probably not, but the market will want that hedge. So I think the other side, the other tail we want to hedge is this thing lasting longer, right?
Yeah.
So I think maybe looking at Viva or Ampol, they're already up 20% this month, so it's not a new idea, but they could go substantially higher if this thing does continue longer.
And a couple of inflation-linked revenue stocks as well. What do you like?
Yeah, so this is, I think back to 2022, Juliette, when we did have an outbreak of inflation and everyone was running for the covers. Like the bond market was getting killed, the share market was getting killed. This stagflation, which people are starting to talk about, stocks that did really well had inflation-linked revenue. So the obvious example in Australia is Transurban. They own most of the toll roads around the country, and those tolls have an inflation link in them. So they go up generally by 5% or inflation, whichever's the higher, depends on the concession. But in the big one in Melbourne, the one that goes from the airport, the Transurban CityLink, that has a CPI link. So let's say that inflation goes to 5 or 6% in Australia, which it possibly could, based on these high fuel prices. That means your tolls on driving on that road are going up by 6%. Does it cost any more to run the road? No. So that revenue goes straight to the bottom line. APA, which is a pipeline trust business, yes, it moves gas, and everyone thinks it's linked to fuel. It's not, it's linked to inflation. So the higher the inflation, the more companies have to pay to move their gas down that pipeline. So that's, again, a very good inflation protection. Go back to 2022 and look how those two stocks did. They performed very, very well. So you want those businesses, and there's a couple of utility companies as well that also have that, and there's a lot of offshore companies that have that. There's lots of infrastructure companies where the amount that they get paid is linked to inflation. They're great protection if there's a spike in headline inflation.
There you go, everyone. You've got to keep it on Ausbiz. We just had 4 stock picks from the CIO of Shaw & Partners: Viva Energy, Ampol, APA, Transurban. Martin, great to chat as always. Martin Crabb from Shaw & Partners. All right, and speaking of stock specifics, the stock of the day on the call today was Myer. Andrew spoke to our experts, Andrew Coleman from Team Invest, Rudy Philippek Van Dyke from FN Arena.
Personally, I'd be more than happy to hold stocks for the next decade if I can. So Myer would be not on my list. I mean, I'm just not interested. My favorite observation, that's obviously before they bought some assets from Premier. My favorite observation was that their sales had peaked in the mid-90s. Just think about this for a while. Maximum peak sales in the mid-90s, and we're now in 2026. Maybe as a long-term investor, you want to buy into companies whose business goes up over time, and not the one that goes sideways at best.
On a PE of 4 says either the market really doesn't believe this can continue, or this is going to be the bargain of the century. I think, unfortunately, with the history of Myer, it's more likely that the performance won't continue than that the market is wrong here. It's a sell for me, and I think our Team Invest members on principle. There'd be no point owning a retailer with no moats that's going backwards. But maybe Olivia can turn it around. The joy, of course, of being an investor is you can watch that from the sidelines rather than having to take the constant fear and headache of being in it and watching.
You've worked hard for your money all your life. Now your money needs to work hard for you. Whether you're building, transferring or drawing down, the right information makes all the difference. At Ausbiz Retire, you'll find the latest news and insights from trusted experts all in one place. Ausbiz Retire is powered by RAM, retirement income done differently.
Well, it was an update, just not quite as up as we were expecting, but let's have a look at some of the leaders in today's session. Liontown Resources lifting there by about 8%. In fact, a lot of the lithium players looking good. Genesis Minerals, IGO Mineral Resources also very solid. Let's have a look at the laggards though, and that included Drone Shield down more than 6%, Guzman y Gomez down about 5%, NAB off by 4%. In the small end of town, these stocks did well. Echo IQ, we mentioned on that FDA approval, up by some 18%. Clover was up nearly 20%. And to the downside today in the small end of town, Amplia Therapeutics was off 17%. Vinyl was down by around 9%. Let's have a look at what investors will be focused on tonight, apart from what's happening in the Middle East. US and UK PMIs are due. And then tomorrow locally, we have February CPI, of course, very important, and then some earnings coming through from Solpats and Tuas. Worth noting, as we said earlier, the February CPI data will be backward looking and not take into effect what we've seen with global energy prices. Let's have a look at how we finished the day's trade, just up by 1/3% there on the CBO 200, where the ASX 200 is finishing the day's session firmer by just 13 points, or 0.1% to 8,379. So it sold off quite a little bit heading into the close. And just hearing as well, Santos has been hit by an outage at its Barossa LNG plant. All right, that does it for this edition of the COB. We'll be back from 9:45 a.m. Eastern tomorrow. We'll see you then.